story. It's the story of the day. Robert Luna is CEO and Chief Investment Strategist at SureVest, a CI financial company, joining us live from LA with his thoughts on the matter as well, because that's all the market is talking about. Robert, good to have you on the show. Tell me the market is not busy with this discussion. And if so, what are your thoughts?
Yeah, look, I mean, there's a lot of headlines out there right now. There's a lot of reasons to be pessimistic. And I think, yeah, the popular thing right now is to really beat up on the Fed and talk about how there's going to be this tough landing. And I think we heard there's a 90% probability now of a hard landing. And I'll say there's a 90% probability that no one really is going to be able to predict exactly what's going to happen. So I think what we're trying to figure out now, what we have to do with real money is make actionable decisions every single day of where to place that capital. And so you have a few choices. You could obviously be in the bond market, you could be in real estate, you could be in the stock market. What I would say with all these things is, we talked about how much of it has been priced in already. When you look at the NASDAQ, yeah, we've run up 17% in just the last couple of weeks. We're now back above the 200-day moving average. But if you look beneath the surface, there's a lot of stocks, Tanvir, that are still down 40, 50% from where they were 90 days ago. So the question also in some of these equities, how much of it's already been priced in?
Exactly. You know what's rather interesting in your notes is that you still like old tech, Facebook, yeah, Google, Amazon, and believe this is the biggest opportunity despite rates going up, despite all the other challenges that these tech businesses are facing, especially on the social media side, especially Facebook, which is now Meta.
Yeah, I mean, absolutely. When you look at these technology companies, these aren't the technology companies of 20 years ago. When you talk about Amazon, when you talk about Facebook and Google, they have fortress balance sheets. They are going to be able to weather inflation. They're not nearly as dependent on a lot of the input costs of, say, a Sherwin-Williams or someone of that nature is. So these companies are a lot more resilient. They're a lot more mature. These are $2 trillion companies that are still growing the top line at 20%. So I think in this type of environment, that's actually become a new safe haven. And when you look at the old safe haven of consumer staples, energy, yeah, I understand why money's gone there. But if we have to make investment decisions based off of the next 12 to 24 months, I'm not that comfortable buying consumer staples at 22 times forward earnings.
Don't you think, though, that if yields are going to continue to rise, Robert, that it's going to be difficult for some of these so-called growth tech names to keep on rallying?
Well, I mean, I think if you look at what's been going on for the last 6 months, really, Mandy, they've gotten decimated. So I think that's the point I guess I'm trying to make is, 6, 12 months ago, we loved Chevron, we loved the dividend growth stocks. We still have them, obviously, as part of a balanced portfolio, but we're much less optimistic on those. I'd rather buy these names that are growing 40, 50% and are still down after this decline that we saw. Names like Twilio, Path, Coinbase, they're still down 40, 50%. So a lot of that's been priced in. So when I take normalized growth rates of what we think will happen, even compressing the multiple, because there's a case to be made that the multiple can't remain so high, they're still the best place for us to put our 2 to 3 year money.
And I guess when we did see that rout earlier on in the month with regards to these big tech names, it certainly hurt the overall market as well. Which begs the question that for the rest of the year and maybe going into next, are the tech names going to continue to dominate and lead the market, or do you think that we could start to see rotation into other kinds of sectors?
Well, there's just barely now. We only have 2 weeks of really a rotation over the last several months back into technology. So a lot of people are still waiting for some technical confirmation of should we get into technology. And this is something I've been talking about a lot, Mandy. I've been in this market since 97, 98. It used to be great to wait for all these technical setups before we got in. But the speed of change in these stocks now, if you wait for those things to happen, technical analysis has actually become, in a lot of cases, a lagging indicator. We were just hearing about the death cross 2, 3 weeks ago, traditionally a sell signal. It was actually the buy signal. And if you look at the last 5 death crosses, it's really been the inverse of what people have thought historically. So the most important tool you can use today as an investor is conviction. Understand what you own. Understand that when ETFs get sold off, even the good companies are going to go down. But the only thing you have as an individual investor is time on your side. So if you can weather these storms and buy these stocks at big discounts, that's the way you're going to make money long term.
Tell you what else is down, Robert. It's Chinese tech and Chinese ADR. So as a US-based investor, do you see value here? Do you think the dark clouds are clearing just because of the signaling that we have seen over the last couple of weeks?
Well, I mean, like the challenge there, Tanvir, is when you look at companies like Tencent, when you look at companies like Alibaba, you know, those are great behemoth companies, very well-run companies. The challenge is you're dealing with, if you're here in the U.S., this political risk that we don't know what's going to happen. Are they going to delist these ADRs? And so when you start looking at trying to forecast those things, it's very hard for me as somebody who manages someone else's money to go into those types of names with that amount of uncertainty. That's not traditional uncertainty of the economy or just the market being bad. That's a structural change that if that happens and I don't have an opportunity to wait for the stock to come back because I can't trade in it, that's something I really can't invest my clients' money in. And that's a big issue that you're going to see for institutional investors who've gotten out of those names.
I just wanted to get your sense whether or not the conviction is moving in around that issue. Lastly, where would you cash out? If you okay, growth stocks is where you're going in, but where would you book out? Where would you book profits?
Yeah, I mean, the two stocks that we've paired most of our gains and have really bring them down. The only two stocks I've sold in the last couple of weeks are Lockheed Martin and Chevron. Why? Well, take a look at why is Lockheed Martin up 30–40% year to date. It's obviously the war. Are we going to be at war, and is that going to be sustainable for the next 2 to 3 years? Well, I seriously hope not. Valuations got ahead of themselves. The same thing long term. The long-term story on oil is not that bullish. There's been huge run in Chevron, these energy stocks. So I would say some of the defense contractors, Northrop, Lockheed, and some of the big energy stocks, Exxon, Chevron, that's where I would be taking some profits today and putting that into some of the areas like tech that have lagged.
Great to talk to you as always. Robert Luna joining us there from Shorevest. Thank you so much, sir.